The return, not of the Pink Panther, of the offset mortgage. Return of the offset mortgage. Now, do you remember the offset mortgage from your studies? If not, I'm going to remind you what they're all about. Now, they're actually becoming more and more popular amongst mortgage brokers because the world has changed. Since like last year, the world has changed. Fixed rate mortgages, are becoming a little bit of a gamble. People aren't quite sure what's happening with future interest rates. Everybody has an opinion, but nobody really knows what's going to happen. So fixing at, say, 5 or 6% or whatever seems to some people to be a bit of a gamble. Tracker mortgages are great because they track the Bank of England base rate at a couple of percent more maybe. But even though the Bank of England base rate is probably going to go up to 3.5%, might go up even more next year, we don't know, do we? So what are the alternatives then? Well, the alternative is the offset mortgage, because interest rates on mortgages are quite high, but savings account interest rates are still languishing very, very low. And that is an ideal environment for allowing an offset mortgage. So let's just remind you how they work first of all. So what I'm going to do is do your little graph, because I'm a visual kind of guy and we learn by visual, don't we? So the whole point about the offset mortgage is that you have a mortgage. So let's just put our first line in there. You have a mortgage, and this one represents interest rates. So that's high and low. There you go. So high rates. Now the problem at the moment is that mortgage rates are quite high. Well, they are in comparison to what they've been. So let's just put that into context. And this line down here represents the amount of money that you've borrowed. So that's the amount that you've borrowed. Here you go. So just for our purposes, and we'll do 200,000 there, shall we? Just to give ourselves a bit of a working paragraph coming on here. We'll do 200 there, and we'll do 100 here. So you can just see how things are working out, can't you? There you go. So that's your graph. So if we put a mortgage into that for you, so you can see where the mortgage comes in. So let's put a mortgage of a couple of 100,000 in there, shall we? There you go. There's my mortgage. Now I'm putting up here because interest rates are quite high at the moment. So I know I'm just throwing a few rates out. Let's just say 6%. So that's the 6% there. So we've got a mortgage here of 6% at 200,000. Now that, as you know, is going to give you mortgage interest payments. I've already worked this one out. So that's 200,000. Let's put that in there for you. 200,000 at 6%. This is interest only, just to keep it tidy, is £1,000 per month. So that's nice and easy to work out. And that's great. Fix it at 6% if you wanted to. Now, the whole point about the offset mortgage is that people have savings accounts, usually with the same provider of the mortgage, which is why these were quite popular from banks and building societies, because they encourage people to put their savings with them as well. That's fine. Now this particular customer that we've got in mind has savings, so let's give them savings there. We'll put that there for you so you can see that. Oh, no, but give them so much savings. Give them, drop that down a bit there, nice and tidy. We'll give them savings, and we'll give them £100,000 in savings, as you can see from the graph there. Now, the thing about savings is the rate is really low. Depends where you go, of course. You can get good rates and low rates, but we've got a few thousand on savings, which I'll talk about in a second. We're earning 0.10%. They haven't budged it yet because they don't need to, do they? Now I'm gonna just to say, I'm gonna give this savings account a 2% interest, which is quite generous actually. Now here's how it works. Now the savings account of £100,000 would normally earn you, here we go, so £100,000 at 2%. That's going to earn you per month, this is, and I've worked it out, 166 quid, £166 a month. Now that is taxable. Now obviously you've got your personal savings allowance, 500 quid for high rate taxpayers, grand for standard taxpayers. You've got a savings allowance, but you still are liable to tax on that, so it might be slightly less than that. Now the whole point behind this mortgage is that what you do when you work out your monthly payment for the mortgage, you offset your savings against it for that particular time, that day or that month or whatever it is. So what you do, let's just take a green pen here, is you effectively put this savings account, you offset it against the mortgage, which then reduces the amount of mortgage in which you're paying interest on. So for that particular month, just take it as a month, you've offset that savings of 100,000 against your mortgage, and the lender won't pay you this, obviously, because you're not getting interest on that for that month. But what they'll do is they'll reduce that. So that comes down, a different colour pen there for you. That then comes down to £100,000 because that's all the mortgage effectively you need to pay interest on. That's £100,000 at 6%. You don't need a calculator for that. That brings that down to £500. So although you're foregoing interest on your savings, your mortgage is only 500 quid a month for that month. Now that's brilliant, isn't it? Think about it. Now you've got a couple of options there. You can obviously save yourself some money that month in monthly payments, or you can actually just pay the normal grand and reduce your term if you've got a capital interest mortgage. So that's not a bad little option either, is it? But also, it means you still got £100,000 in savings. You haven't lost that money. So if the roof blew off the following month, you can still have the roof fixed because you still access your savings. It's pretty cool, isn't it? Now, the interest rates are a little bit higher than normal mortgages, but, you know, as competition comes in, it might bring it down again. But if you've got somebody who has a bit of money in savings and they don't really want a fixed rate, then this ain't a bad deal. So what kind of people are you thinking about? Well, first of all, Shelley and I are kind of in this position as well. But we've got a fixed rate mortgage, which runs out in early 2024. So we're probably thinking our mortgage rate is going to go right up. You know, it's fair enough. It's just the way it works. Not happy with it, but you know, it's the way it works. So when we come to refix our mortgage or remortgage our mortgage, then we'll probably go for another fixed rate at sort of 5-6%, whatever it is at the time. Now, we have the ability to pay a little bit of money off that mortgage beforehand, which would be nice to do, to reduce the debt. And that's an option we have. Now, what we could do instead is take out a offset mortgage and use that savings that we've got to offset against the mortgage payments, which may well reduce the term quite dramatically. And we still have access then to our savings, which is quite an important thing to do, isn't it? So that's one example of a customer that might be relevant for this. You might have somebody who's self-employed, for example, or an owner-director running their own company. And she puts some money aside each month towards her corporation tax bill, her income tax bill. She may even put money aside each month for her VAT bill if she's a consultant and charges VAT. And there's quite a considerable amount of money can be put aside in a deposit account, earning hardly any interest. So what she does, she puts that into the savings, VAT money, corporation tax money, which is payable once a year, income tax money twice a year, and offsets it against a mortgage. I think that's a brilliant thing to do. Makes absolute sense to do that. It could be a client of yours has got some money from the pandemic. A lot of people still got money that they didn't spend in the pandemic, and it's still in the savings account earning hardly any interest. A lot of people don't like to use that either. They want to keep that now in case the world blows up again. Again, offset mortgage, offset it against the savings. They don't lose their savings. That's the whole point. That's a good one, isn't it? Now, here's one you'll love to bits. And this is for all those people that work out and create equity release mortgages. Now, equity release or lifetime mortgages or later life lending, there's a lot of innovation going on there. What you do is a lot of old people who retired are looking to release equity from their property to, maybe fund their children's education or something, like grandchildren's education or something like that, which is great. A lot of them still have money on savings. I'm not talking about people who are on, pensions credit or anything like that. I'm talking about people who are relatively wealthy income-wise, but they just want to use their property to pass on to their grandchildren early. They've got money on savings. They're earning a tiny interest rate, and they don't want to use that. And okay, you put across that you do, but they don't want to use it. So what you do is you create an offset retirement mortgage. For those people who create these things, you can thank me for that. It's just a basic interest-only mortgage. So it'll be a RIO of some description, but you offset it against savings. It's a brilliant idea, I think. But the later life market is certainly innovating on its products and things like that. So I'll put that on LinkedIn, see if anybody likes that idea. Now, your action plan then, your action plan as a mortgage advisor is think about your clients now. When you talk to them next year, and they've got this fixed rate coming up for renewal or whatever, because you're going to do a lot of that, aren't you? MOTing people's mortgages and stuff like that, people that want to be refinancing and remortgaging. I mean, let's face it, that's pretty much the only business you're going to do next year. There's not a lot of purchase going on. have a look at the offset. Get yourself up to speed with various offset mortgages available, and then find out what's going on. You need to do a long-term fact find with people. You can't just do, a fact find. You've got to ask them where they're going to be in 5 years' time, 10 years' time, 15 years' time maybe. Do a lifeline on them. Google. I've got videos on Lifeline. We talk about Lifeline a lot. A lifeline is a brilliant 10-minute thing where you just know the future of your customer. And you should do that, because that way the offset mortgage might come into its own. Because they might have savings which are planned for a purpose in the future, and therefore they don't want to spend it. You could offset it in the meantime. Hey, I've given you a good example there of a new mortgage, or an old mortgage actually, that may well become quite popular next year. I hope you have that useful. Bye.